Today, I'm going to break down the pros and cons of 4 popular all-in-one ETFs and explain which one is best for which type of investor. So if you are a new investor wondering how to build a complete portfolio with just one purchase, this video is specifically for you. All of these ETFs hold many of the same world-class companies like Apple, Microsoft, Amazon, and Google, Tesla, just in different proportions. And I'm going to walk through these 4 funds in order from lowest to highest expense ratio. That's the annual fee you pay to own each fund. So you can see how costs compare across your options. So let's start with ZEQT, the lowest cost option at 0.18% expense ratio. ZEQT is BMO's newest entry into the all-in-one space, launched in January 2022. And BMO recently introduced its fees to make it among the most competitive in Canada. Like the others, it provides global diversification using BMO's underlying ETFs with roughly 24% Canadian allocation, giving you home bias for Canadian investors. And home bias just means investing more in your own country's market. ZEQT's main advantage is ultra competitive fee structure, making it attractive for cost-conscious investors who want to keep more of their returns. However, it's the newest of these funds, so it does have the shortest track record compared to the others. ZEQT is best for investors who want global diversification at the lowest possible cost and don't mind a shorter performance history. And really quick, I've noticed 80% of viewers aren't subscribed. An easy way to support this channel for free and move me a little bit closer to my 10,000 subscriber goal by New Year's is hitting that subscribe button. All right, next up is XEQT at 0.2% expense ratio, just 0.02 higher than ZEQT. XEQT offers balanced global exposure by automatically spreading your money across Canadian, US, and international stocks through 4 underlying iShares ETFs. Think of it as a fund that holds other funds. XEQT gives you 23% Canadian exposure and has been around since 2019, giving it a longer track record than ZEQT. The downside is that XEQT's fund of funds structure creates an extra layer of fees, and the Canadian allocation is higher than Canada's actual share of global markets. So XEQT works best for Canadian investors who want global diversification with a proven track record and don't mind paying slightly more than ZEQT for the iShares brand. All right, third is VEQT at 0.24% expense ratio, following a similar approach to XEQT, but with Vanguard's investor first philosophy. Like XEQT, it holds 4 underlying Vanguard ETFs for global exposure with 24% Canadian allocation. Vanguard is owned by its fund shareholders, which keeps their focus on low fees rather than profits. And VEQT also launched in 2019. VEQT has the same limitations as XEQT, the fund of funds structure and Canadian overweight, but costs 0.04% more annually. VEQT is best for investors who specifically value Vanguard's philosophy and want comprehensive exposure through the Vanguard ecosystem. And finally, we have FEQT, which comes in at the highest expense ratio at 0.43%, more than double ZEQT's cost, but FEQT takes a completely different approach by holding individual stocks directly rather than other funds. This gives excellent global diversification across North America, Europe, Asia, and emerging markets. And emerging markets are just developing countries like China, India, and Brazil that offer higher growth potential, but a lot more volatility, or a little bit more volatility. Uniquely, FEQT also includes 3% allocation in cryptocurrency exposure. FEQT's higher fee reflects this direct stock picking approach and cryptocurrency inclusion. And the emerging market exposure adds volatility. FEQT is better for younger investors with 20 to 30 year time horizons who want comprehensive global exposure, including crypto, and can handle more ups and downs. So here's the reality. Performance differences over 10-20 years will likely be minimal between these funds. The fee difference ranges from ZEQT's 0.18% to FEQT's 0.43%, but they're all reasonable for what you get. The most important factors for success are just starting early, contributing regularly, and staying invested through market cycles, not which specific ETF you choose. So let me put this in perspective with real numbers. If you invested $7,000 per year in your TFSA, that's about $583 per month. For 30 years, using conservative 7% annual return estimate, you'd have roughly $708,000 with any of these funds. So, and you would have only invested $210,000 of your own money, meaning about $500,000 would come from compound growth. That's compound interest working for you. The fee difference between ZEQT's 0.18%, FEQT's 0.43% would create about $38,000 difference over 3 decades. And that is significant, but the most important factor is actually starting and staying consistent. So here's my recommendation. If you want the lowest possible fees with global diversification, choose ZEQT. If you want global exposure through proven iShares platform, choose XEQT. If you prefer Vanguard's philosophy, choose VEQT. And if you want comprehensive global exposure, including emerging markets and cryptocurrency, choose FEQT. Personally, I would lean towards ZEQT, mainly due to its lower expense ratio. Those fee savings really do compound over a decade and can make meaningful difference in your final portfolio value. But honestly, you could pick any of these 4 and achieve excellent results if you stick with the plan. So set up automatic contributions, max out your TFSA first, then your RRSP, then taxable accounts. Focus on increasing your contribution amounts over time rather than optimizing between these already excellent choices. And if you want to calculate all those potential returns yourself, check out my free investment calculator in the first pinned comment and description below. And let me know in the comments which all-in-one ETF you prefer. And check out these videos for more investing tips. Bye guys.